Welcome back. You're watching London Eye. We've been discussing emerging markets and the outlook for the rest of 2013 with Austin Forey, Managing Director of JP Morgan Asset Management Company, who runs more than $10 billion across 4 funds in emerging market equities. How do you see valuations for the Indian market generally in a relative sense? Because we've been such a range-bound market. Periodically we'll sell off and then we'll pull back and then it hits a ceiling and goes back from there. Do valuations become difficult after a point for India?
Yes, I mean, India is never a cheap market in a conventional sense. You know, I look at other places like China, where you can find lower multiples, higher dividend yields. So India has always been, for us, about compounding growth over the long term. And where you can find businesses that can do that, you can make tremendous investments. So I mentioned earlier on HDFC, and you know that's a company which I've met now for 20 years. I think the earnings have grown over 15% a year for that entire 20-year period. And frankly, if you can find one of those, I wouldn't say it doesn't matter what you pay to begin with, but valuation is not a reason to keep away from those things. And the worst mistakes I've tended to make in my investing career have been ones where I've thought, that's a bit expensive. And yet it turned out to be an HDFC type business which had huge sustained growth trends. And frankly, I should have paid up. I could even have paid above the marketplace and it would have still have been a great investment. So we try not to be, too concerned about very precise valuations. I think there's a lot of spurious precision that goes on in investment thinking. If you can find businesses which compound, then provided you don't make a catastrophic valuation mistake, for example, of the sort you saw in the middle of the internet bubble in '99, you'll do just fine in the long term.
HDFC has worked out beautifully for you over the last 10, 12 years. It's been a fantastic compounding machine. But the ones which have been more up and down are some of these big telecom plays like Bharti, where you've seen high valuations and then a big period of underperformance. How do you reconcile investments with these kind of names?
Well, Bharti originally was a tremendous growth story. And in fact, we had a lot of investments in mobile telephony around the emerging world throughout the 90s and trying to buy them as early as possible. And Bharti was a good example of that. I mean, it's a stock we invested in, I think, for the first time 6 months after the IPO, at a price a lot below the IPO as well. And I think if you look at mobile, there are no other industries in the world where so much market cap and so much profit was created so quickly in the last 20 years. You know, it went from being non-existent to being an essential utility of everyday life. And even in the early days, people used to say, I heard people say this, penetration in India will only ever get to 5% for mobiles. And you look at it today, that was such a completely wrong forecast. So our original investments in Bharti were predicated on the view that this could be a very big company, and we didn't know how big, but we were prepared to stay in and find out. I think more latterly, they obviously made a big acquisition in Africa, which stretched the balance sheet a bit, and then clearly the whole telecom sector ran into issues of competition, a bit of a price war, and clearly a lot of sort of political and regulatory issues bubbled up as well. So some of those things I think are foreseeable, some of those things come from outside, and in general as investors, we try to worry about risks we can foresee, and the ones you can't foresee, you can't worry about anyway.
Sure. What are your big underweights in India? Of the big companies that you look at, which areas have you steered clear of in terms of your portfolio structuring?
Well, we don't own Reliance or anything in the chemicals, petrochemicals, commodity space at all. So we tend to get our commodity exposure elsewhere in the world. I don't think, particularly in primary commodities, by which I mean, oil, gas, mining.
So you don't own Coal India either?
No, we don't own Coal India. At least I don't own Coal India in my funds. We have a variety of funds which have different mandates in our team, so other people have different positioning. But I've always got my commodity exposure in other parts of the world where you find really low-cost producers. So we don't own those things. And otherwise, we have pretty selective exposure to the consumer sector, which is mainly not because we don't like the businesses, but because some of the valuations are particularly challenging at the moment.
Autos?
No autos.
Not a single name?
No. But you should understand that I run a fund which holds 70 stocks around the whole world.
Yeah, of course.
So we'll have 6 or 8 names in India, and that's it. We're very selective.
There is a feeling among some Indian investors or investors who look at India that maybe with the growth slowing down to 5-6%, markets like Indonesia, Turkey, Philippines will continue to outstrip India in terms of market performance. Is it just because those markets have done well over the last 1 year, or do you think there's merit in that argument?
I think the fact they've done well might well be a part of it. But the real comment I'd make is that economic growth, in our opinion, doesn't have a lot to do with equity returns anyway. There's a lot of studies which show you very little correlation between economic growth and equity returns. High costs of capital is paradoxically a good thing when you're looking to make returns on investment. And so some of those places you mentioned, Turkey tends to have quite a high cost of capital. It's a fairly inflationary economy. Philippines was off the radar screen for a long time. It has done very well indeed in the last 2 or 3 years. But for us, India is not about the macro story. I mean, if you were worried about the macro story, you'd end up with all your eggs in a Chinese basket where the macro has been fantastic. We are stock investors. We buy pieces of companies and we try and keep them for a long time. And I would say that India for us has always been a big contrast between some tremendous businesses and a macro situation which, while it's delivered very good growth rates, has had inflationary cycles and it hasn't reached Chinese rates of growth, but it doesn't matter. In the long term, you've made more money in the Indian equity market than in the Chinese one, and that's about how companies use your money and what returns they make.
You're long-term investors, but the last 5 years, which is not very short-term, it's not been a great equity story, perhaps which led to or fed a lot of disenchantment back home amongst local investors. Do you think the cycle could well be turning, or do you think this will get more protracted?
Well, if you go back 5 years, you're catching almost the peak of the Indian equity market,
Sure.
So that's perhaps a slightly unfair starting point. We were reducing our exposure in India 5 years ago because valuations were really, really high by the end of 2007, and clearly then you sailed straight into the financial crisis within a year. But as I said to you, we've been increasing our exposure in India over the last 12 months. We're pretty optimistic about long-term returns from the stocks we own there.
So what's the ranking in order for BRICS for you in terms of exposure or overweight for the big BRIC market?
Well, India is our largest position among those markets, especially versus the index. We have investments in all of those places. We have investments in Brazil, we invest in China, we have a variety of exposures all around the place, but India is top of those four at the moment for us in the funds that I manage.
What worries you most? What can go wrong in India?
Everything can go wrong. I think you need to see, we obviously worry about inflation cycles and the economy, but we've actually held some of our investments through multiple economic cycles. So provided that businesses capture inflation in the long run, we're not too bothered about that. We worry about, I suppose, political effectiveness and how regulation changes and so on. For example, the general sales tax is probably quite a significant development as and when it arrives. And we do need to think about how that's going to affect different businesses, because it's going to have a marked effect in different sectors. Those kind of political developments they're important for the corporate sector. So we need to keep on top of how business is reacting and interacting with the political policy making in the country. Not always easy to foresee that one, but broadly speaking, I suppose our attitude would be, and someone actually said this to me in India recently in a company meeting, that if you have to run your business to cope with whatever comes, and if you can't do that, then your company's not good enough. And if you can do that, you'll be fine anyway. And the ones we invest in, I hope, can deal with whatever comes in India, and will do fine.
Do you see the elections as a risk? I mean, the political construct which may come up in the next 1 year?
I'm not a political specialist, and I certainly wouldn't forecast political outcomes. I think India has a very good basic framework. Unlike some of the countries we look at, it's a democracy, it's a capitalist system, it has the rule of law, and that's not a bad starting point. So elections need to go kind of badly wrong, I think, from the point of the equity investor, really to derail the long-term story, and that's not what we expect.
What do you hear from your clients or your end investors about equity exposure? Are they still coming in gingerly, or would you say the mood is very confident?
It depends a little bit which part of the world you're talking about. I'd say that we have clients all over the world. I would say that the Europeans are still pretty cautious. There's quite a lot of risk aversion still in Europe, which is understandable given what's been going on in the last few years in the Eurozone. I think we see probably American clients, North American clients, more optimistic, but they're also more optimistic about their domestic economies. So I'm sure that's a part of it. But we have seen inflows from really all over the world, actually from all different continents into our business. So it's a bit difficult to pick and choose between attitudes. Generally speaking, we think investors are still underexposed to emerging markets, so to some extent they're still increasing their structural exposure, and that's obviously good for us.
But if the US continues to recover later or through the year, do you see emerging markets getting their proportionate share of money, or do you think people will want to be in the US or Japan?
I think it's a bit of a headwind, frankly. If you look at what happened in the mid-90s when the US recovered from the previous big banking-led downturn, you're absolutely right. If the US is doing well, you don't need to chase returns by taking risk around more distant parts of the globe as far as US equity investors are concerned. So to some extent, yes, that's true. But we were investing through that period as well, and that's not a handicap to producing reasonable results for your clients.
Do you worry about the Indian currency at all? Because it's taken away quite a bit from global portfolios over the last few years.
We worry about it much less now. Obviously, the rupee's been a little bit weak in the last couple of years. It doesn't look overvalued to us at this stage. So, if anything, that was a risk we were thinking about a couple of years ago. It's played out, and then you stop worrying about it. But from the point of view of our investments, what we really care about is how do they react to inflation? The rupee and the inflation rate in India are two sides of the same coin, in my view. If you have a business which has inflationary pricing power, then in the end they'll get it back again. If you have a business which can't recoup costs as they go up, then you're just going to lose on the currency.
Austin, a pleasure. Thank you very much for your time.
Not at all. Thank you.